Rockets and Knicks were in Game 5 when OJ started that fateful drive. His four-way hazard lights were blinking, and no one knew what the juice was thinking.
I've been to Reno, Chicago, Fargo, Minnesota, Buffalo, Toronto, Winslow, Sarasota, Wichita, Tulsa, Ottawa, Oklahoma, Tampa, Panama, Mattawa, La Paloma, Bangor, Baltimore, Salvador, Amarillo, Tocopilla, Barranquilla, and Padilla. I'm a killer. I've been everywhere, man. I've been everywhere, man. Crossed the desert bare, man. I breathe the mountain air, man. I've traveled, I've had my share, man. I've been everywhere.
This is Oversight Live, your advocate for good governance. We're putting the site back in. Oversight. Here's the watcher on the wall, your host, Ben Carpenter.
Hey, good evening, everyone. Happy Thursday. I hope today was a good day for you. I have been looking forward to today. Ever since I previewed the meeting that we're gonna see tonight, I've been excited. So this is good. We're gonna get going here. So what is Oversight Live? Well, if you're wondering, if you're new, if you're just checking us out, Oversight Live is my attempt to bring the road to Juneau to you. Our capital and our legislature in the state of Alaska is only accessible by road or by boat, by ferry. And it is prohibitively expensive in both time and money for most Alaskans to go visit our capital on a regular basis. So providing oversight over our elected representatives and our government is a greater challenge for most Alaskans than most Americans. So Oversight Live's your road to Juneau. Until a real one can get built, a lack of a road is a major inconvenience to us, but it is no longer a valid excuse with today's technology for not knowing what's going on. So my intent here is that we're going to bring you convenient and relevant content so that you can be informed, educated, with the actual truth, meaning we're going to show you the video and you can make up your mind. We'll provide the links or show you where you can find it, and you can go watch it yourself. You don't have to take my word for it. You don't have to filter the liberal media bias. You will have my bias, and I am unabashedly a limited government, fiscal conservative, social conservative, and you'll have to deal with that bias, but at least I'm upfront with it. You have the opportunity to engage with yours truly and with other Alaskans while we're live on this show. Just chat into your social media app there, and I'll get the message and I will try to answer it on air as best I can. If you're listening to this as a recording, then go ahead and shoot me an email at the producer at email. Is when you're clicking and speaking at the same time. Producer@oversightlive.com. Producer@oversightlive.com. And I'll get your email and I'll do my best to answer your question if you're trying to engage me. So I served 6 years in the state legislature here in Alaska, and I really don't want my time to go to waste. So I'm going to do my best to share with you what I learned and provide some context that maybe you don't get if you haven't served in the legislature or haven't been in Juneau, to see what's going on. Kind of peel the curtain back and see what's happening from a different perspective. And I'm going to share that with you. And I'll do my very best to share what I've learned. If you ask questions, don't be surprised if I share the question or if you've got a question, odds are somebody else has got the question. So we'll take that opportunity to edify all of us with the answering of questions. So tonight, let me just check and see who we've got online here. Good evening, Craig. Good evening, Tawny. Good to have you with us. I see that. Craig, that's a good idea. Maybe we should talk about that. It'd be interesting at some point to discuss the legislative committee process, how assignments are made, what committees you serve on. Oh, you want my personal opinions on which ones I liked and which one I didn't. All right. Well, if I can't find anything else to talk about one of these days, then you'll get my, you'll just get me talking on my experience. Anyway, well, hi, Lynn. Good evening. I sat down and tried to clip the Senate Finance meeting from 9 a.m. from yesterday. And it's a presentation from Callan, which is the paid consultant, and they're paid by the Permanent Fund Corporation to help model and communicate performance and other things that the corporation wants to have communicated. And I tried to sit down and clip it, meaning distill out the things that aren't really relevant. And the more that I went through it, I'm like, you know what? I think all of this is relevant. Like, how do I get to the end of the meeting where there's really some deep things that we need to be considering, but not having the knowledge at the first part of the meeting. So I've got the entire thing queued up here. It's an hour and a half long. I'm going to try to step through it as quickly as I can. I've got a fast forward button here when it's pertinent, but I think that we really do have to set the stage for, I don't know who all is going to be listening. So we really have to be aware. Some of the things that we're going to talk about in the meeting here, how the global markets have performed, which is pertinent to how well the permanent fund has performed, and they'll show us that too. They'll kind of get into why the fund is diversified and how it is a little bit, and and this is the thing, is this meeting is chaired by Senator Stedman, who's the finance co-chair. So he's got the capital budget this year, not the operating budget, but he's steering the conversation. And I want to put that up front. I want you to recognize it and understand that's what's happening. So he's going to ask some leading questions. And the reason is because he's got an end state. He's got some place that he wants to take the public for what he wants them to know. Okay. So Callan's going to talk about what the different payout or draw rates mean for the future of the fund. They're going to talk about what risks exist under this 2-account structure, meaning the statutory structure we have right now with an earnings reserve account and a permanent fund. The earnings reserve account being the fund that all of the earnings of the permanent fund corpus get deposited into, and the legislature can spend that with a simple majority, whereas all of the funds that are in the corpus, the legislature cannot spend, period. So that's where we're going here. And we'll have a conversation at the end. I'll ask the question at the end. What do you think the takeaway is? What do you think they want you to know here? And along the way, we're going to hear some things that are pretty, like, did you realize that you're admitting that? Like, I think it's an important meeting. It is fundamentally, we are making a decision in the state of Alaska, the legislature is, about what to do with our spending and what to do with our revenue, taxation, right? 113 bills or something like that from this legislature on proposed tax ideas, right? I mean, it's one form or another. The legislature is demanding more money, and it's coming from taxation or it's coming from the permanent fund dividend. Anyway, so let's get started with this right away, and don't hesitate to drop a question if they've said something you don't understand. We'll pause and try to explain it. So, the meeting here is chaired by Stedman, like I said, Senator Stedman. You've got Senators Olson, Kaufman, and Kronk on the left side of the screen, on the left side of the table. And then you've got Senator Hoffman, Senator Keel, and Senator Merrick all on the right side of the table. And then the two individuals here are from Callan, and they'll introduce themselves. So here we go. Let me get this shared. Make it big.
All right. Thank you, Chair Stedman. For the record, my name is Greg Allen. I'm the CEO of Callan. We've been the consultant to the Permanent Fund Board since we actually can't determine exactly when we started because it goes back so far, but in the mid-'80s, I think we first started working. I've personally been working with the Permanent Fund since 1989. I built a model that we've used with the Permanent Fund to forecast the financial health of the fund over time and look at various things like asset allocation and so forth. So I'm here to sort of represent that component. Steve Center next to me is a Senior Vice President. He's also a lead consultant on the Permanent Fund account. Been on the account for
about a decade,
about a decade. And he typically talks about performance. And so today we're going to go through performance, give you guys an update on how the fund has been doing. We'll talk a little bit about the capital market projection process that we do for the Permanent Fund and how they come up with their asset allocation and what that should look like going forward. And then we were asked to comment on some perspectives on the draw, how much you can sort of safely pull out of the fund and have it be sustainable for future generations of Alaskans. And so we have some analysis on that as well, which we'll cover at the end.
Okay, I don't want to cast any aspersions on the credibility of these individuals, okay? But I do want to highlight that the Permanent Fund Corporation is paying for the data and paying for the analysis and paying for the communication that is happening to the legislature by Callan. And I want to point out that Senator Stedman is also requesting this, so that when the CEO here says, hey, that the paid consultant says, we've been asked to speak about a particular subject, that means the chair, Senator Stedman, has asked them to address these specific topics. So this is where where he wants the conversation to go for a particular reason, okay? We'll get into the meeting here. You'll hear him banter about this later, but Senator Olson, Senator Stedman, and Senator Hoffman at the head of the table right next to, those are the co-chairs of finance, and they'll identify that they have been, basically running the show for 25 years. Okay. So I think that's important. You've got a CEO of Callan that's been involved with the Permanent Fund Corporation and now has his own business and is a consultant and is providing the mouthpiece, if you will, for the Permanent Fund Corporation in concert with the legislators who are trying to steer this conversation in a particular direction. I think you as the public need to know and understand that that's the context where this information is coming from. I'm not casting aspersions on the information at this point. I'm just saying that you need to know that these wealthy people, they have an opinion and they're steering the conversation towards that opinion and that outcome that they want to see. All right, let's move forward.
So with that, I'm going to turn it over to Steve with the permission of the chair.
And Mr. Center, I think I refer to you as Chief Financial Officer. I think it's Chartered Financial Analyst. Is that what that is?
That's correct, sir.
Okay.
So we're going to start on slide 4. This is just to set the stage for framing the performance of the Permanent Fund to help you understand how the capital markets performed through the end of 2025. So the next 3 slides are looking at benchmark performance for the capital markets, not the Permanent Fund's performance. I want to stress that. So you will see asset class performance here just to help you understand the drivers of the overall performance of the Permanent Fund. So starting on slide 4, we're looking at the public markets performance through, my apologies. Through the chair, Steve Center from Callan. I overshot that, my apologies. Starting on slide.
So just so you're aware, the reason that there was a pause there and he had to give his name is because when he started speaking, he didn't do that. And there's somebody over in the corner, that's staff, that's taking notes, and they don't know who he is. They don't remember what his name was. And every time you see a speaker that enters into the conversation, they need to be either recognized by the chair. That's why the Senator Stedman will say, Senator Kaufman, go ahead. And then the guy that's taking notes knows that it's going to be Senator Kaufman that's talking. In this case, the chair doesn't do that for the guests. He's expecting the guests to identify themselves when they start talking. That way it's clear on the recording and it's clear on the note taker who's actually doing the talking. So if you are curious why this happens in every single committee, that's why. It's part of the official record. All right.
Slide 4. We're looking at public market performance, so equities, fixed income, and cash. Last year, non-U.S. equities really drove performance. That green bar on the far left, non-U.S. equities had a positive 32.4% return. Much of that was driven by overall weakness from the U.S. dollar. When the U.S. dollar weakens, non-dollar currencies strengthen. That is a tailwind to performance for investing outside of the U.S. But overall company performance outside the U.S. did quite well, as did U.S. stocks. So while non-U.S. stocks were up 32%, the U.S. stock market was up over 17%. So continued strong performance from the U.S. stock market. And when you get out over longer time periods, 5 years and 10 years and beyond, you'll see that the U.S. stock market has been the key driver of performance for institutional investors, really over the last decade. The bond market, as we all know, interest rates went up post-COVID. When interest rates go up, bond prices go down. We've seen the Fed reverse here in last year in 2025. When interest rates go down, bond prices go up. So we saw the bond market return a positive 7.3% last year. But when you get out to that 5-year period, that brown bar for the bond market, you'll see is still negative, a negative 0.4% return. And that's really driven entirely by the movements of the Federal Reserve with increasing and then now decreasing interest rates. Flipping ahead to slide, if there's any questions?
Yeah, I got a question. Maybe you can define what the alphabet soup is?
Yes. Thank you, Chair Stedman. So the alphabet soup in the top right, referring to the various benchmarks. So the Russell 3000 index is the broad measure of the U.S. stock market, U.S.-based companies. MSCI ACWI ex-US is the Morgan Stanley Capital International All-Country World Index ex-US, so excluding the United States. So this includes both developed and emerging market stocks. The Bloomberg Aggregate Benchmark is a broad measure of the U.S. bond market, looking at treasuries and corporate bonds and mortgage-backed securities. And then the 3-month T-bill is just a simple measure of what you would get investing in cash.
And for those who are watching, we have the Russell 3000 Index, I think, is a selection in our SBS and deferred compensation accounts so that you can cross-reference that if you'd like. I'm pretty sure it's the Russell 3000. There's a Russell 4000 also?
No, there's a Russell 2000, which
so
is
that
a
is
Talking about the
subset.
defined contribution
Correct.
retirement system, not the defined benefits retirement system.
Moving on to slide 4, this looks at performance for the, moving on to slide 5. This looks at performance for the private markets. So in addition to investing in publicly traded securities, the permanent fund also invests in private equity, private credit, real estate, infrastructure, and a basket of hedge funds.
Just pause real quick and say that this is not new, but this is not how the permanent fund has always been invested. Originally, it was heavily invested or maybe totally invested in bonds when it was first instituted and first growing, right? And so over the years, the asset allocation or what you do with the money, where you invest the money in the fund, has changed at the direction of the board of directors of the Permanent Fund Corporation.
And so we've pulled together some representative performance from various benchmark providers to show you what the performance has looked like in the private markets over the same time period as we looked at on the previous exhibit. So private market returns have been a bit more muted, particularly relative to the public equity space. You would expect things like private equity to outperform public equity over longer time periods because you are giving up liquidity and you need to be compensated for that. And we do see that when we look out over the full 20-year period, that private equity still outperforms public equity. Private credit, similar to private equity, when you are lending money to companies on the private market space rather than buying a publicly traded bond, you should be compensated for that risk. And that is also evident when you look at longer term performance. However, we haven't seen the same sort of snapback post-COVID that we have seen in the public markets. What I will say is you have far lower volatility in these spaces because they just are not marked to market as frequently as the public market space is. You will see the one outlier on this chart is the real estate market. Post-COVID, there's been a lot of headwinds in real estate, not only from the increase in interest rates, but the move towards work from home has really impacted the office sector. And then the retail sector has really been impacted post-COVID as well. So these are two of the larger areas of the institutional real estate space, and they continue to struggle a little bit. We have seen signs of plateauing and a beginning of a recovery, particularly now that we've seen interest rates begin to come down again. I want to stop there for any questions.
Go ahead. Go ahead and continue.
So slide 6 just looks at those same benchmarks, but solely over that long-term 20-year time period. And this just helps illustrate how the private markets do tend to outperform the public markets over the long term, even with this near-term period where the public markets have done very well. When you look out over the long-term time frame, private equity outperforms public equity, private credit outperforms public bonds.
So I think on this, are you done with this slide?
Yes.
So I think on this, a few years ago, we were having some discussions with the permanent fund on the private equity side, where the permanent fund was in that space earlier than most, leading to some pretty handsome returns. And they were cautioning us that going forward, there will be more competition in that space, and those returns are going to regress more towards the mean, and they're not going to have the performance. So is that what has materialized, or?
I would say we are still fairly early in that game, but I'm sure this comment came from CIO Frampton. So I recognize Marcus Frampton's opinion, and we do agree that, first of all, your point, Chair Stedman, that the permanent fund was very early into private equity is very true. They have a very mature private equity program. They've been investing in these private companies for a very long time. It's one of the top tier programs that we see in the public fund space. They also, as you've heard from CIO Frampton, he has been fairly vocal that he doesn't want to grow his public equity program as a grow his private equity program as a percentage of the permanent fund's assets, really beyond where it is, because for that same exact reason that you just said, that there's been a lot of dollars piling into that space. The spread that you can get between public equity and private equity has narrowed, and the overall benefit, therefore, from taking on that additional risk just gets smaller and smaller. So while they will continue to commit assets to the space, as the permanent fund continues to grow, they're going to have to still contribute and to the private equity side. They are not likely to grow it as a larger percentage of the permanent fund going forward, at least in the current environment.
Okay. Have other questions on this slide? Okay, seeing none. Next slide, please.
The next slide is what Callan calls our periodic table of investment returns. It is a bit of an eye chart. The concept here is to help you understand the overall benefit of diversification, why we recommend and why most institutional investors create portfolios that are invested in not just public equity and fixed income, but also the private market.
Okay, real quick, just to show you what's happening here. At the top of the chart here, in case you can't see, are years. This is 2016 on the left to 2025. The boxes at the top, right underneath the years, are your highest performing sectors or markets. And they're color coded so that you can see where they are over time. So for example, in 2016, the top return was 13.8 in that year, and it was from infrastructure. But then in 2017, infrastructure was in the middle of the pack. It was greater return, 14.4, but it wasn't the top return. Non-US equity had jumped up to the top as 27.2. Okay. So you can see that if you're just looking at investing in infrastructure projects, it is all over the board here as far as expected returns, right, from year to year. But the same thing you could say for non-US equity. In 2016, it was down, 3 up or 4 up from the bottom. 2017, it was at the top, and then it was down at the very bottom in 2018. So that's the value of this chart, is just to say if you were wanting to invest in just one thing, like some people say, well, if we could grow the fund faster if we just invested more in private equity, because private equity gives you an opportunity for a greater return than other sources. But so that's U.S. equity. Where's private equity? This is the kind of a turquoise or color here. Don't ask me what the actual color is. It's kind of light blue. Private equity bounces around here, as you can see. So if you were investing just in private equity, for example, and this is why the diversification model matters. If you were just investing in the thing that's going to get you the biggest return, theoretically, well, it wouldn't every year. So this is why you put your money into a whole bunch of different baskets, and over time you do better because of the diversification. And that's all that this chart is valuable for right now.
It's because on individual calendar years, you cannot predict which asset class is going to be the top performer. It's very rare for you to see a asset class that is at the top of this individual calendar column one year and then is continually at the top of that column. So think of this as just a proof statement for why diversification matters. Slide 8 looks at the performance of the permanent fund as of the end of 2025. The permanent fund returned 12.5% last year, slightly ahead of its total fund target of 12.2% and well ahead of the CPI plus 5 target. When we look out over the last 3 years, the permanent fund has lagged.
Okay, let me explain something, because he just threw an acronym out there that you might not know about. CPI plus 5 is your consumer price index plus 5%. That is the goal, the target for the permanent fund corporation. CPI, or inflation, plus 5%. That's what they want to be able to, that's their target return that they're going to be shooting for. So in this chart, you can see that the kind of the olive green is their target, and then what they actually, no, that's just measuring CPI plus 5. They've got their total fund target is listed higher, and then the actual return is in blue. So anyway, what I wanted to explain was the CPI plus 5 means inflation plus 5%.
Its benchmark by about 1.2%, but is still ahead of the CPI plus 5 target. The 5-year period with a 7.9% return, the fund outperformed its benchmark, but slightly lagged the CPI plus 5. As a reminder, that 5-year period includes that rapid rise of inflation that we saw post-COVID, which is not in that 3-year number. When we get out over the longer periods, 10 years, 20 years, 35 years, the permanent fund has outperformed its performance target over all time periods and just slightly lags the CPI plus 5 over the trailing 20 years. So overall strong performance versus its performance benchmark.
This is key, because our performance over the last 20 years, if you just measure the last 10, performance is doing better than CPI. But if you're measuring it over 20 years, then your performance is not beating inflation plus 5%. Okay. Go to 35 years and now it's beating it again. So it really does matter what the scale is, or where you start measuring from. And they might talk about this again in another slide, but it really does matter where you start measuring from.
Performance benchmark is a blended, a weighted index of the underlying asset class benchmarks for the permanent fund. So a very good measure of how you would expect the fund to perform, and is a good way to see how well the investment team has been implementing within its various asset classes. So by outperforming that benchmark over time, it's a clear proof statement that the investment team at the permanent fund has done a very good job of implementing their investment plan.
Okay, that is a opinion statement based on the data that they're showing us from the guy or the organization that's being paid by the Permanent Fund Corporation to communicate what the corporation wants to be communicated. Okay, so just keep that in mind. The value that you might find in these numbers and where they should be related to maybe your knowledge of how other investors have been able to do over the same period of time you might come to a different opinion, because you've seen what other people have been able to do, other organizations or other decisions have been able to do. So just take that for what it's worth. This is the paid spokesman for the Permanent Fund Corporation.
Slide 9 looks at the permanent fund's performance versus strictly that CPI plus 5 target over the full 35-year period. So this goes back all the way past 1991. This includes 3 rather substantial market corrections: the dot-com bubble bursting, the global financial crisis, and the COVID epidemic. Even with those 3 substantial market corrections, the permanent fund has been able to exceed that CPI plus 5 target over the full 35-year period. But as you can see, by investing in the public markets and the private markets, there is volatility versus that CPI plus 5 return, which is very smooth. Unfortunately, there is no investment you can make that will give you CPI plus 5. If there was one, I would invest in it in a heartbeat. The only way you can really hope to meet that target is by creating a basket of investments similar to what the permanent fund has done.
So are you at some point in your presentation going to talk about where the 5% came from?
The CPI plus 5 target? That's a great question. It's been around a long time.
Yeah, we actually, through the chair, Greg Allen, we actually spoke about this at the board meeting for Monday and Tuesday, and we're kind of going back through the history because we've talked about the CPI plus 5, and it has been one of the benchmarks that we look at going back to, as far as we can tell, the 2005 or 2004. But there were folks on the board or that were involved that thought that it may have gone all the way back into the early 90s. So I think just for the industry as a whole, CPI plus 5 is a return objective that if you invest in a diversified portfolio of stocks, bonds, and other things, I think generally the consensus is you have about a 50% chance of beating it. So if you think about a distribution of returns, good returns, bad returns for any asset class, people tend to focus on the middle, the expected return it's called. And the expected return of a portfolio like the permanent fund is right around CPI plus 5. So the industry's kind of coalesced around that as a long-term benchmark. It would allow you to spend 5% from an endowment, for example, and still keep up with inflation. So a lot of endowments out there use CPI plus 5 as an objective. I will say over the last 20 years, that has come down a bit. So I think when we look at the large endowments, they're kind of split. Some of them are still as high as 5. Many of them have moved to 4.5. If you look at the average target for an endowment these days, it's right around 4.65, 4.7. So that shows you that some of them are at 5, some are at 4.5. So I think it is a general consensus achievable target with a recognition that you're going to have about half the time you're behind it and half the time you're ahead of it.
Let's also keep in mind, and I see your comment, Craig, that it's not hard to beat CPI plus 5. Let's also keep in mind that we are talking not about personal money and personal investment decisions with your own money. We're talking about managing public funds. So what is acceptable? What is an acceptable amount of risk that you want to take or your private organization wants to take with its money to get maximum returns? And yeah, so you can get better than CPI plus 5%, but the more return you get, the higher risk you've probably accepted to lose your principal, right? And so we're talking Permanent Fund Corporation these are public funds. So pushing the envelope in getting maximum returns but accepting maximum risk, in my opinion, is probably not the wisest thing to do, because these are public funds, not your own private funds. If we're wrong, many people are impacted here, not just you if you were wrong with your investment decision. So we have to keep that in mind as well.
Okay, and then at some point, I think you need to talk about how that's related to your asset allocation.
Yes, that'll be the next section.
Okay.
The next slide is the same analysis that we just did, but rather than looking at 35 years, we look at 25 years. So we lop off that first 10 years. This is just an illustration of how important the time period selection is. If you start running the clock in 2001, right before the dot-com bubble bursting, it looks like the permanent fund has not been able to keep pace with that CPI +5 target. So this is just an illustration to help you understand the importance of the time period that you choose, and that you shouldn't, we call it the power of cherry picking, right? You want to make sure you look at the longest term time period you can when you are evaluating performance. The next few slides compare the permanent fund's performance and risk characteristics versus two different peer groups. The first being Callan's large public fund peer group, which is predominantly state-sponsored pension plans. The second is Callan's large endowment and foundation peer group, which is large endowments and foundations. The reason we compare the permanent fund against two peer groups is twofold. The first being it's a unique asset pool that really doesn't have enough peers for us to create a robust distribution of returns to compare against. We really need north of 20 observations to make a decent peer group, and there's just not enough US-based large sovereign wealth funds, for all intents and purposes, that we can compare the performance against. The permanent fund historically was more invested like a state-sponsored retirement system until about 20 years ago, 20-ish years ago, early 2000s. At that point, its asset allocation shifted more towards an endowment and foundation model structured to support an ongoing payout. So comparing the performance against the two peer groups ultimately makes sense. It's kind of a tweener for all intents and purposes. It sits between the two. So we're going to start by looking at the large public funds on slide 11. You will see that over the last 3 years, the permanent fund has lagged other large public funds. The key reason for that is that most large public retirement systems have substantially more invested in the public equity market. We just saw how strong the public equity market has done over the last 10 years. That is the key driver of the reason why the permanent fund ranks in the bottom quartile versus large public funds over the last 3 years. Most public funds have about 45% in public equities. The permanent fund has about 32% in public equities, so substantially less. That being said,
So one of the reasons they're pointing out, and so this is the Permanent Fund Corporation's message and their consultant's message. I'm not casting aspersions on the data because I'm not the expert here, but they're arguing that because the other funds that they're comparing themselves to had larger allocations, asset allocations, or larger percentages of their investments were in public funds than what the Permanent Fund Corporation has in public funds, meaning they put a larger distribution in other things like private equity or other. And because the public funds have done better than the choices the Permanent Fund Corporation has made, that's why the Permanent Fund Corporation appears, has underperformed compared to these handpicked peer funds or peer groups.
once you get out beyond 5 years, the permanent fund, even with that near-term underperformance versus public funds, 5 years, 10 years, and 20 years, the permanent fund is above median. So the 33rd percentile over the last 10 years, the 49th percentile over the last 20 years. That's the number in the little parentheses next to that distribution bar in the chart.
Senator Keel.
Thank you, Mr. Chairman. Mr. Senator, the weight to public equities is, you said, the biggest factor. Is the choice of equities a significant factor? My understanding is that most of public equity returns in the last couple of years have been driven by a very small subset of companies. Has the permanent fund chosen differently within that allocation?
Yes, to a degree. So through the chair, Steve Center again, what you're talking about is in the U.S., there's been a key drive, the Magnificent Seven effect, right? The concentration of the S&P 500 and the fact that these 7 large companies have really driven a large proportion of performance in the marketplace. Additionally, the U.S. up until last year was vastly outperforming non-U.S. stocks. The permanent funds public equity portfolio, like most active public equity portfolios of institutional investors, has been underweight to those Magnificent Seven stocks. It is very difficult for an active manager to overweight very large positions when they are as large as these Magnificent Seven stocks are. It takes a lot.
So we like to say that because we're investing in the S&P 500 or a mutual fund or some kind of fund that's investing in the S&P 500, you automatically think, okay, well, that's a lot of companies. But what's being discussed here and what you may not understand is that much of the growth that's being realized, that's actually happening, is based on the performance of 7 companies. They are influencing the S&P 500 more than the rest of the companies. They're the main movers and shakers here. So if they're struggling, those are U.S. companies, and if they're struggling, considering the fiscal situation in the United States, considering the president and tariffs and the challenges that presents for U.S. decisions. Now think about this: if you've got, and I'm going to go down a rabbit hole for very quickly, but you've got large companies who their model has been to outsource U.S. companies outsourcing much of their production and their operation to other countries that are cheaper. And here comes President Trump that says, you know what? You've gutted our country, our economy, and our ability to generate wealth and provide jobs here is being hurt by your decisions to outsource things to other countries. So we're going to put tariffs in place that incentivizes bringing that production, that wealth creation activity back into the United States. And this, again, is maybe why some companies are pushing back on the tariffs, because they're like, well, now we got to make a decision. Do we continue? Do we pay the tariffs? We figure out how to make our business work with tariffs in place and keep our model of production with overseas production, or do we bring it back into the United States and not have to pay the tariff? So this is part of the design or the impetus behind why Trump is using tariffs, is to try to get U.S. companies and other companies to come start doing things in the United States that provides jobs for Americans and not ship those jobs overseas. Maybe that has something to do with why your Magnificent Seven in the S&P 500 have kind of struggled, because there's a reorganization or a reordering of the U.S. economy based on the presidential use of tariffs and that political decision to try to pull jobs back into the United States.
Of gumption to say, I'm going to hold 8% of my portfolio in Apple. It's hard to do, but when it is that big of a portion of the index, that's the only way you can overweight a stock. So that factor that you mentioned has resulted in the permanent funds public equity portfolio slightly lagging the benchmark over that last 5-year period. Additionally, the permanent fund is a little overweight non-U.S. stocks versus U.S. stocks. When you look at the market capitalization weighting, that was ultimately a tailwind last year with the strong performance we saw from the outside the U.S. That has been a systematic overweight that the permanent fund has had, both non-U.S. stocks and smaller capitalization stocks, which have lagged large cap stocks in the U.S. So you are correct that the underweight to public equity as a whole, the first factor I mentioned, was a factor to the underperformance over the last 3 years versus the peer group. But how the implementation has been done has also been a bit of a headwind. What I will say is that is not at all uncommon versus other large institutional investors. It is just very difficult to structure a public equity portfolio that is even market weight to these large holdings that have begun to dominate the benchmarks. We have seen some of that correct just in the last year. In 2025, only 2 of the Magnificent Seven stocks outperformed the S&P 500. So we've begun to see a bit of a correction to that overall impact.
Okay, we saw the slide earlier that had all of the different squares showing the different groupings of which you can invest in, right? And how they shifted over time. investment performance, right? What I want to point out here that might be obvious to everyone, but in case it's not, the asset allocation decision of whether to shift money one direction or the other is a strategic decision. It is a forecast decision. It's looking at what the totality of the environment is, what demand is, what for in a given sector, or what economic forces are happening within this country and other countries, what politics are happening. So there's a broad range of things that go into making a decision as to how we want to allocate the investment of the funds within the permanent fund. And the people who are doing that thinking, who are responsible for making that decision as to where this goes, and listen, and who they're going to listen to, right? Listen to Callan, listen to other people that they hire for the information to make those decisions. That is the permanent fund corporation board of directors. Okay. Those board of directors right now have public members, 4 public members, and 2 or 3 members that are members of the administration. One of them has to be the Department of Revenue commissioner. And then and anyway, so all of these members get appointed by the governor. So one of the major foundational decisions on the health of the permanent fund corporation and the direction that you go with your investing is the asset allocation that this board makes, that decision. Okay. We have a bill in the legislature that says the legislature would like to have a say in approving the appointments that the governor makes to that board. Right now, the legislature has no say. It is just 100% up to the governor. And if this bill was to be approved, this is a bill that Representative Sarah Vance has drafted. If that bill is approved, then the legislature would end up being able to confirm the public members of that board as the bill is currently written, giving some check and balance here by the people's representatives, the legislature, and not just accepting whatever the governor, whatever direction the governor wants to go, right? It would also cause those seats to be staggered so that they wouldn't all be coming due all at the same time. So I personally, from a checks and balances perspective, I think it is time for the legislature to have a say. It does politicize it a little bit, or a whole lot, but if the direction the state government is going is to consume all of the permanent fund earnings, no dividend, and state government is going to be decided, the amount of money available to state government year to year or decade to decade is going to be decided by the decisions of these board members, right? The allocation decisions. Then I think the legislature needs to have a say in the membership of that board going forward. I'm not casting any judgment on whether continuing to consume the permanent fund earnings to pay for government is a good or right way to go. I'm just saying, if that is the way we're going, that is the only fiscal plan we have in play right now, then the legislature needs to have a say in that makeup of that board. Okay, that is not part of this briefing, but I thought it would be pertinent at this point to kind of highlight that. All right.
Thank you.
And then on your slide here, 11, do you guys work with our pension plan?
I am a co-consultant on the retirement plan.
Okay, so I don't have those returns memorized, but I think the return on these are calendar years. It's not
So
an
the-
adjusted.
I
ending
actually
December
have those
31st?
numbers with me, so I'd be happy
Okay.
to go through those.
So the calendar year return for the pension, a lot of times they use fiscal years, and we got to do conversions around here.
Yeah.
I think it's around 13%.
So
So there'll be another meeting in Senate Finance to talk about PERS and TERS, and I'm going to fast forward through this because it's not really germane. Senator Stemmen just wants to get it out there that there's a comparison of funds, permanent fund performance compared to the other funds that's managed by the state. But for purposes for today and what we really want to talk about towards the end of this meeting, I want to step past this.
the ARM board's return, this 0.03. It's 1 basis point higher.
Okay.
So very similar return over the last 10 years, but it got there in a different way, right? A different asset allocation.
I think what we'll have you do at some point when we take a look at the pension plan performance, we'll have you populate this chart with that on there.
Question.
Senator Kaufman.
Thank you, Chair. So the slight difference in performance indicates a different allocation. And if you could just, I guess your risk profile determines the allocation. So is there a reason for the different risk profiles and the resulting allocation? Is there some other driver for it?
A reason for the different risk profiles between the permanent fund and PERS?
Yes.
These are very different liabilities. Okay, the PERS plan is focused on a pension plan liability with a finite life. The permanent fund is structured to be a permanent fund and to last in perpetuity. So it's structured more like an endowment fund. Very different liabilities and risk profiles. We would not recommend that they be invested in the same manner.
Thank you. I just wanted to highlight the driver for the allocation and then the resulting performance. Thank you.
Next slide.
Slide 12 compares the permanent fund versus our large endowment and foundation peer group. So again, this is endowments and foundations with assets over 1 billion. A very different return profile than you see from the pension plan universe, and that is because the endowment and foundation universe has far less in fixed income, far less in public equity than the public plan does, and far more in private markets, alternatives, things like private equity, private credit, real estate. The permanent fund has fallen into the bottom quartile over the last 3 years with this peer group as well, but again, over the longer time period, so even with that near-term lag, over the 10-year period, it is right below median, 9.02 versus 9.19%. And over the long-term 20-year period, again, just slightly below median. However, the risk profile you will see on the coming slides is actually slightly lower than most endowments and foundations. So it has been able to earn about a median return over the last 10 years with a lower risk profile than most peers.
So the numbers down here at the bottom are showing you the returns over the time, last year, last 3, last 5, last 10, last 20, and then what ranking or what percentile compared to the peer group the returns fall into. So the median return in the last year was 14%, but over 20 years, the median return is 7.47 in the group. And this over the last long term, the last 20 years, then that means that the Permanent Fund Corporation total fund here earned 7.27%, which is below that median of all the peer groups that they use to compare this with, right? So it's not in the bottom of the peer group where some other endowment didn't do as good as the Permanent Fund Corporation, obviously, because they've only got 6% return. And not to cast aspersions on that either, just saying that maybe they've got different goals, and so they only want to reach 6%. I don't know, but the point is just that the Permanent Fund Corporation comes in underneath the median of that peer group by a hair, right?
Okay.
My final 2 slides look exactly at that, at the risk versus those same 2 peer groups. So slide 13 looks at the 10-year standard deviation and Sharpe ratio for the permanent fund versus large public funds. Standard deviation is a measure of realized volatility, so just how volatile the returns have been over that 10-year period. You'll see that the permanent fund falls into the bottom quartile versus large public funds. It's had a far less volatile return pattern, and that is, again, because it has less invested in the public markets. Public equities and public fixed income are inherently more volatile than the private markets. Sharpe ratio is a measure of risk implementation. Think of this as a return per unit of risk, how well the risk that is being taken is resulting in positive performance. And the Sharpe ratio for the permanent fund over the last 10 years is very much in the top quartile. So The investment team is taking measured risks that are paying off well compared to the other peers in this peer group.
And do we have a center ratio?
I wish.
Sharpie was an actual person.
Yes, he was. Sharp was indeed an actual person.
Nobel Prize winner.
Nobel Prize winner.
I was just checking them.
I am sadly not a statistician by trade. Economist, but not a statistician. Slide 14 does the same analysis versus the large endowment and foundation peer group. So you'll see that again, the standard deviation is below median, but not as far down in the distribution as we saw versus the public fund peer group. But it is still above median on the Sharpe ratio side. So again, a slightly lower risk profile than most endowments and foundations. And the implementation of those risks that are being taken continue to be positive versus the peers. I want to stop there for any questions we have about performance before I pass things to Mr.
Does have
Allen.
any questions? Okay, we'll go on to the next section.
Can I take that keyboard from you? Thank you. For the record, Greg Allen. So this next section, we're going to talk a little bit about asset allocation. Asset allocation is the exercise that every big institutional investor goes through to decide which asset classes to invest in and how much to invest in each one. And that becomes the strategic plan and the roadmap for how the staff and all of the managers that work for the fund implement the program. So we go through this process every year. We take a look at the asset allocation for the permanent fund. On an ongoing basis, staff will make recommendations to the board to adjust it. Usually it's a 1% move here, a 1% move there. And we help to evaluate what that might look like going forward. So this is a little bit of an exercise of looking out into the future to understand asset allocation at the permanent fund. So the foundation on slide 16 of this process is that we do capital market projections. So Callan, we're in this business. We do this for hundreds of clients. Every year we use the same expectations for every client. So we have a team that gets together and essentially forecasts the return for the next 10 years, the risk or the standard deviation, and then the correlation, which measures the interaction of these asset classes. So correlation is actually a very important number. When two asset classes have a low correlation, that means one zigs, the other zags. And when you put them together, this magic thing happens where you get a little more return and a little less risk. So that's at the heart of asset allocation and building portfolios. So we've been forecasting these things for a long time. We do it every year. We use the numbers with every client. And so we're going to show you what the permanent fund looks like in that context with a little bit more background. All right, on to the next slide. These are our capital market projections for all of the asset classes that the permanent fund is currently invested in. And at the very bottom there with the little orange circle is the expected 10-year return annualized for the permanent fund going forward, 7.3%. So that's the headline number. Notice that inflation is 2.5. So it doesn't quite get you to 2.5 plus 5. And we'll talk a lot about that going forward. We've done this for years and years for the permanent fund. Sometimes their expected returns above inflation plus 5. Sometimes it's below, just depending on what we think the capital markets are going to be able to deliver.
I want to plant a seed with you right now. Once the dividend goes away and the permanent fund is paying for state government, the earnings are paying for state government. Any amount of positive growth in our investments means there's more money for the state government to spend every year. Okay. So for example, this year, whatever they did in the permanent fund corporation resulted in about $200 million more in permanent fund earnings that the legislature gets to spend this year. Okay. Now, understand that that's not the only source of revenue for our state government, and there might be fewer dollars coming in from oil royalties and oil taxes. So that means that the overall amount of money that we have to spend, it may be less. But from permanent fund earnings, the source of permanent fund earnings, we have $200 million more this year than we did last year. Okay. So what I'm trying to point out is, if over the next 10 and 20 years, every time the legislature meets, there's no dividend, and every year there's $200 million more, or some dollar figure, because we've continued to increase the size of the permanent fund. So every year there's more to spend. There'll be another chart later that I'll show you how this works. That means every year your government gets to spend more. It gets to grow. So the question from a limited government guy, do I want excellent returns on my, do I want much more than CPI plus 5? Or do I even want that? If it's going to result in more money and more government, why do I want that? So think about that first as we're going through this. I think this is a legitimate question that we're going to have to wrestle with.
The only other thing I would have you take away from this chart is that the permanent fund is an extremely well diversified portfolio. Every one of those line items is a big portfolio that's being managed independently and well. And then when you put them all together, you get the permanent fund. So it's a complex portfolio. It's a $90 billion portfolio. And I'd say it's one of the, in my view, one of the best run portfolios amongst our clients. All right. This is just a graphical representation of all of those returns that were on that previous page with risk. So risk is on the y-axis, or the horizontal axis, and expected return, is on the vertical axis. And the idea here is to show you two things. One, if you want more return, you have to take more risk. You can't have high returns and low risk. The capital markets just don't let you do that. So the other thing to say about this chart is, if you look at the permanent fund portfolio dot, it's above almost all the other dots, but with less risk. That's the power of diversification. When you mix U.S. equities with U.S. fixed income and hedge funds and emerging market debt and all those little building blocks, you get this kind of magical property where, because they offset each other over time, the risk gets reduced and you still are able to achieve the high return. So our whole goal when giving advice to clients, and pretty much the goal of every institutional investor, is to be in that place. We call it the efficient frontier, where you're getting the most return for that amount of risk. And then you just have to decide how much risk you can afford to take. All right. This is our little report card on our shelf. So these, I focus you on the orange line and the green line, or I say that teal, I call it teal or aqua. This is just showing you back, so I'll take the first dot. This is 1989. This was the first year that I was involved in the capital market projection process at Callan, or responsible for it. We take a portfolio made up of equities, fixed income, and real estate, 60, 30, 10, so a kind of representative portfolio. We put our expectations in there, and we come up with a number. So at that time, we thought that portfolio was going to do about 11%. Then we wait 10 years and we see how we did. And if the orange dot is on top of the blue dot, that means we got it exactly right. If the blue dot's below the orange dot, it means we guessed too high. And if the blue dot's above the orange dot, we guessed too low. So I had beginner's luck. My numbers were actually perfect in that first year. But you can see you can't always get it right. It's a hard thing to do, to forecast the future. I'd point to 2008, where back in 1999, we had no idea we were going to have a dot-com bust and a global financial crisis all in that 10-year period. So, of course, the blue line was well below the orange line. We guessed way too high back in 1999. But this is just sort of to give you some maybe confidence that these numbers that we're coming up with are pretty reasonable. I would also say that our projections have generally come down. So back in 1999, interest rates were a lot higher. So it's been harder and harder to earn the same return over this time period. All right, I'm going to skip this slide because there's just a lot and I don't need it. This is the permanent fund's asset allocation. So you can see that 20% in public fixed income, 32%, as Steve referenced, in public equities, which is a global equity portfolio, 18% in private equity, 11% in private real estate, 10% in infrastructure and private credit, and 7% in the hedge fund or absolute return category. And then some cash and a category called tactical opportunities, which is 1% of the portfolio designed for sort of the CIO to, if he identifies a market dislocation, he can invest in the team, can invest in opportunities. But if they don't have any great opportunities or ideas, it's generally just invested in the S&P 500, which is what most of it is right now. So this has a 7.3% expected return, and we estimate the probability of beating 7.5%, or inflation plus 5, to be a little under 50%, about a 47% chance that it's going to beat it over the next 10 years. All right. I think I'm just going to, I'll show you. All right, so this is actually an important beat it over the next 10 years. Probability of beating 7.5%, or inflation plus 5, to be a little under 50%, about a 47% chance that it's going to beat it over the next 10 years.
Okay, so Callan is saying that the likelihood that the Permanent Fund Corporation and their strategy, their asset allocation, their strategy going forward, the people that they hire, the decisions that they make, there's a 47% chance that they make or beat CPI plus 5%. So less than half the time they're projecting that the corporation is actually going to be successful at reaching CPI plus 5. Okay. So when we hear, this is really, really key. When we hear we must protect the fund by rolling the ERA into the corpus, that takes all of the spendable money and puts it under lock and key, all of the earnings, puts it under lock and key, and then they say, well, we'll put a 5% draw rate from the legislature. Okay, so now constitutionally, you can only draw 5%. Okay, half the time, less than half the time. So I guess the way I should say it is more than half the time, Callan says you're not going to get CPI plus 5. Okay, so inflation plus 5%. Okay, stick with me here. If you're not earning 5% plus inflation, but you're drawing 5% out of the fund, meaning you didn't earn everything you needed to combat inflation plus your 5%, where is that money coming from if it's not the earnings reserve account? If it's not earnings that are separated from the corpus? Okay, where would it come from? I hope the light bulb's clicked on. It comes from the corpus. So any given year, and I'm going to caveat this by saying the long-term investor is going to say, so what? So what if you draw down and use some of the principal 1 year, and then you double that the next year or within the 10 years? So it depends on your time horizon. So look at the health of the fund over since inception and say, well, any given year, if you took more out than you earned, it didn't really matter because over the life of it, you made it back up in other years. Okay, so that's what the institutional investor will say. But these folks also are going to say, and our legislative finance director has already indicated, when you remove money from the principal of the fund, you are reducing the amount of money you can earn in the future. Okay, so that is true. The previous slide that we looked at showed where he said We got it right sometime. We guessed about what the future was going to look like, and sometimes we guessed high and sometimes we guessed low. That's also true for the future going on from now on. Sometimes we're going to guess right and sometimes we're going to guess low. But anytime that you guess wrong and you continue to take money out, you're reducing the earning power for the future of the fund. And they're going to get to this. They're going to get to this later in the meeting. So I'm looking at this and I'm saying there's a better than 50% chance that they're not going to get CPI plus 5, but let's go ahead and give the legislature access to the corpus so that they can spend the 5% regardless of whether they earned 5% or not. Sounds like a deal. The government gets its money every year. It gets its 5% every year, regardless of whether the permanent fund was actually able to earn 5%. Deal for the government. Not so much a good deal for the fund, if you ask me. What happens if you've got people in the permanent fund corporation board of directors who are making poor decisions on asset allocation, and you have many years where you're down. Okay. I don't know if this is going to happen, but it is plausible. It's possible. Right now we have a structure that prevents that from happening. The corpus of the fund cannot be spent by the legislature. But if there's a group of people that make some bad decisions, or the economy tanks for an extended period of time, and the legislature continues to spend, then you're reducing future generations' benefit for this fund, right? So, anyway, there's some context for you.
All right. I think I'm just going to, I'll show you. All right, so this is actually an important slide. So I'm flipped ahead to 23. That blue line is what we call the efficient frontier. That's using our expectations, that's the most return you can get for each level of risk there. The green dot is their current portfolio. It's right on the line. The orange triangle is if you just implemented with public stocks and public bonds. So it's a very simple portfolio. You could index it. You could buy it with a click of the mouse. You can see that it has a lower expected return and the same level of risk. So I wanted to pick a portfolio that has about the same risk as the permanent fund, but something that you could go back and look at a really long time ago. Private equity didn't exist in 1939, at least there was no index for it, right? So you can't go back very far with the private markets. But I wanted to take a 70-30 portfolio, and if I can move to slide 23, illustrate how it did relative to a 7.5% return over time. So the orange line, so each point on the blue line, let's say that, is the 10-year trailing return. So it's the return for the previous 10 years for a 70-30 stock bond portfolio. This goes back to 1926. The orange line is 7.5%. So you can see 65% of the time or 64% of the time, the blue line was above the orange line.
So we're not talking apples to apples here. If you didn't catch this nominal return, that means it's not considering inflation. Real return would be considering what it was in relation to inflation, right? So we're not talking apples and apples from what we were talking about before.
So it's doable. You can beat 7.5%. But there were some periods where it was substantially below. So at the end of 2008, global financial crisis plus the dot-com, both in there for that 10-year period. You can go back to the 73, that should say 74 oil crisis.
What we really need to know is what this is in real return. 7.5 nominal return is not the same thing as CPI plus 5, which is 5% plus 2.5% inflation, 7%. This isn't accounting for inflation. This is just saying 7.5 nominal. But what's the relation here if you're actually factoring in inflation on this chart? Okay, that's my understanding. If I'm wrong about this, then somebody can correct me. But I don't think they're talking apples and apples here.
Terrible period for stocks. It took 10 years to recover from that. The Great Depression, all the way back in
Look here, average inflation was 3.3%.
That's
So
first
there's
starting point. So
there's
when
your
you have
inflation
these
factor
big
right there. They just aren't
global
factoring it
financial
into the chart.
events, the odds of beating inflation plus 5 go way down. So, and that's just something you have to accept as a long-term investor. And there's going to be a period in our future where the permanent fund, which provides 66% of the state budget, is going to be well behind CPI plus 5. That's just the nature of investing. So get ready for that.
Thank you. Thank you for saying that, because when you have an extended period of time where you are behind CPI plus 5, but you are continuing to take out 5%, you're taking it out of the corpus. You're spending from the corpus. If you have rolled the ERA into the corpus, into the principal, that's the only place you can take it.
Hopefully it doesn't happen on your terms, but it has happened before, and I can tell you it's an uncomfortable, and it affected the dividend in the past. Now it affects the state budget, so there's some gravity to it. It's happened before.
You see the words that they're using. This is why the dividend is gone, because the people who are influencing the decisions in the state legislature have already written it off. Now your earnings are paying for state government, so it's much more important because it's paying for state government versus you don't have as much dividend, right? It's much more important. There's a greater impact. Okay. The conversation that the legislature is having, be careful. I try to emphasize this. The conversation is not a conversation that says, well, we've got this tax rate, and some of the time we're not going to have enough money because the economy is not always going to be booming. It'll be low, or it won't be doing as growing as rapidly, and we won't have as much tax revenue. That conversation's not happening. If it does happen, it's only about oil revenue. This is the distinction that I'm trying very hard to get people to understand. Your legislature and the levers that we have do not care. They're not even considering the private economy where you work. It is not a factor. What they're concerned about is providing revenue to the state government through investment decisions and choices that they make with regard to this large sum of money that they've got. That's the structure that we have. So when we say there's a structural imbalance, it's because that's where the money's coming from. It's the statutes and the structure and the best thinking in the building, and this is where the money is, and the structural imbalances that we have too much spending, not enough revenue. If you take away the dividend, now we've got more money than we do spending. We don't have a problem if you don't have a dividend financially. Not until the government has spent all of the permanent fund earnings on whatever government's going to spend, and then they want to grow more, and there is no more dividend to take. They've spent it all. Then they say, well, where else? How can we grow? Inflation's happening. We got to spend more, but we haven't grown our private economy. We haven't focused on that. It isn't part of the structure that the state government cares about. Then you're going to get a tax, or you're going to have to cut services. One of the two. That's it. Somebody's going to get taxed more, or you're going to cut services. That's where we're headed.
And I can tell you it's an uncomfortable, and it affected the dividend in the past. Now it affects the state budget. So there's some gravity to it.
Yeah. We'll hold you responsible if anything goes
Yeah, thank you. All right. I'll be in California, by the way. All right. I'm going to skip through these slides because I don't think they were in there just in case some questions came up and we didn't need them. So that's asset allocation. I stop here for a second if there's any questions about the permanent fund and why they invest in what they do. And
Senator Cronk.
Thank you, Mr. Chair. I just got a question because a lot of people out there are like, how come we just don't invest in S&P 500 and call it good? Could you explain to the public out there, if there's anybody listening, of why we don't do it that way?
Yeah, I'd be happy to. First of all, you'd be the only one in the world doing it that way. So it's great when you're the only one in the world doing something and you're right. It's much tougher to hang on when you're wrong. The reason you don't do it that way is because you lose all that diversification. So the S&P 500 has been an amazing investment for the last 7 years, 10 years, basically, except for 2022, every year since the global financial crisis. It has benefited, I would say, primarily from the Magnificent Seven, sort of those technology companies. They represent, I think, what do they represent? About 35% of the index now, something like between 35 and 40% of the index. So you're basically taking, $90 billion and investing 35% of that, so call that $30 billion in 7 stocks. That's what you would have if you're invested in the S&P 500. There's no planet on which that's considered diversified in the institutional investment world. And you'd be subject to massive criticism when the piper has to be paid and the entire portfolio goes down 40%, which is what happened to equities in the global financial crisis. So you got to have bonds in there because you just can't absorb that much volatility. That would wipe out the ERA. You would not be able to pay anything out of the fund under the current structure. So you can only afford to take a certain amount of risk in a fund like the permanent fund. I mean, there's a lot of Monday morning quarterbacks out there. We get this like all across our client base. Everybody's sitting in your shoes and the permanent fund shoes. How could you be so stupid? You could have just indexed this thing in the S&P 500. This is a very unique moment in time where one asset class outperformed by that much. And we didn't know back in 2020 that it was going to work out that way. I mean, people thought, I can remember in March of 2020 when COVID hit, and people were thinking it was the end of the global financial system, right? And if you were all in stocks, you took the full brunt of that. So you got to have bonds. The private markets, why do they include private market portfolios in there? Again, that's been a great area to invest over the last 20 years. It's returned double-digit returns. A lot of companies these days don't go public. And if you don't invest in the private markets, you can't invest in these great companies. So again, the permanent fund is reaching out. It went from being, if I think about the history of the permanent fund, it was built off of one commodity, oil. And now it is a globally diversified, renewable resource that's invested in just about everything that generates a return. And I think that, at least in our investment finance world, that power of diversification, you're never going to be the top performing thing because you're not 100% in the thing that does the best. But if you're in them all, you're going to have a smoother ride. And, if you do it right, you're going to be able to earn, competitive returns. It's what the permanent fund has done. So I would argue that it would be completely irresponsible for a large institution publicly. It's the public's money to put 35% of it into 7 stocks. Sounds great. And maybe that works out. You could have put it in crypto. If you'd bought Bitcoin, you'd been up a lot more than if the S&P 500. Or if you just bought one stock, Nvidia, you'd have $900 billion, right? So yeah, there are better investments in hindsight, but looking forward, safety first and try to earn a return along the way. So that's my view, at least.
Go ahead.
Through the chair, Steve Center, I just want to add one more comment. The Uniform Prudent Investor Act has a requirement to diversify, a duty to diversify. So investing only in one asset class, and in particularly, as Greg alluded to, investing 35% of your portfolio in 7 names, that flies in the face of the duty to diversify. So, and also for the record, we do not recommend buying only one stock like Nvidia, just for the record. Thank you.
So that last statement, if you didn't catch it or don't understand what he was saying, it's probably a federal requirement, either a regulation or a law, that with your public funds, you have a duty to diversify. And the argument that they're presenting is that the S&P 500 doesn't meet that diversification. It is not diversified enough to meet that requirement. I don't know whether that's true or not, but that's my understanding of what he's saying.
Thanks for reining me in there, Steve.
Senator Keel.
You can see he got
All right.
personal about that.
Thank you, Mr. Chairman. On the same topic, it's a good discussion, excuse me. Can you talk also about how that compares to the fees and the costs? Because the diversification does bring higher costs, and especially in the private markets. So can you talk to us about how that balances with the returns and the volatility?
Through the chair, Greg Allen. First, thank you for that question, and I know it's a hot button because not only could you have gotten the highest return by being the S&P 500, but you could have done it for like 1 basis point or something like that through an index fund. So we get both of those an awful lot. First off, the performance that we report out to you and to the permanent fund for the permanent fund is all net of fees. So all the fees have been taken out of there before we calculate the return. I mean, they affect the return. They drag the return down. The public markets, you can implement much more cheaply than the private markets. And that's just a fact. Private markets are more labor intensive. The fee structures are what they are. The best, so I'll start with the public markets though, first off. Well, I want to make the general comment that because of the permanent fund's size and position and philosophy, they have some of the lowest fees in every asset class of any investor. So they have amazing negotiating power, and they've used it to their benefit effectively over the years. So their overall cost structure, given the asset allocation that they're in, is as low as it's going to get, as low as they can get it. All right, and it is low relative to other funds, particularly smaller funds who don't have the power to negotiate. In the investment management world, particularly on the public market side, fees are quoted in basis points, but as your asset size get bigger, they ramp down. And so the permanent fund has the power to get to the bottom of what we call the fee scale for most of the products that they're in on the public markets. On the private market side, there's not as much ability to negotiate fees. And that's for one simple reason. The best private equity managers are completely oversubscribed. And they are typically, not only are they the best in the past, but they persist. They've got a business that allows them, they're the first place that people are going to go when they want private equity money, right? So they just get better deal flow. They've got better organizations, and it's statistically clear that there's persistence in the private markets. In the public markets, it's more difficult. The top performing active manager is not always the same manager, but in the private markets, so it's a little bit of there's no pressure on fees for these guys, because if the permanent fund walks away and says, I don't want to pay 2% management fee and 20% carried interest, which is the going rate, they'll simply say, fine, because we've got 20 other investors behind you. And if you look, the permanent fund has to put out about $1 billion a year into private equity just to keep up, because they're getting money back from all their previous investments. To keep it at 18%, they've got to keep committing capital. And we just heard an analysis of their last 6 months of what they've been able to do, and they wanted to commit, I think, I don't remember the exact numbers, but call it 600 million over that period. And they were only able to do 400 because the managers turned down 200 of their 600, right? So this is what they're up against. You just don't have fee negotiating power. So if you want to be in private equity, if you want to be in private credit, if you want to be in private real estate, there's a going rate, and it is higher than managing a public equity portfolio, which has been so automated. And those fees have come way down. So if you go back.
So let's go on.
Okay.
Because what I want to make sure is we get through the presentation.
Yes.
And then we can come back and go into some of these other subject matters, because I think what's coming is.
Oh, it's a big question. I actually think it's the seminal fundamental question for the state of Alaska. There's a debate about the 2 account, 1 account. To me, the most important thing that you can do is to set the draw, ideally constitutionally, at a sustainable level, so that there's not this mystery around what's going to get appropriated every year. So I think the draw is way more important than whether it's a 2 account or a 1 account system. So I'll put that out there first. So what I wanted to do was look at the draw from various perspectives. And by the draw, I mean the percent of the corpus, or the percent of the fund that you're taking out each year.
Is it 5% or is it 4%?
I'm going to go back and look at it as if.
Let me say that again. Is it a 5% of market value, 5% POMV, or is it a 4.5% POMV? That's what he's talking about.
Moved to a POMV back in 2000. So I'm going to look at the past and just overlay the returns of the fund on that and the statutory returns of the fund. I'm going to evaluate a couple different rates of withdrawal. And then I'm going to look at that, kind of looking out into the future. So that's what I'm planning to do. So with that, I want to level set here to make sure everybody understands how the draw works now. So the formula is they take the average of the market value at the end of each fiscal year for the last 6 years. They take the first 5 of those 6 years, and they take the average, and then they multiply that by the draw rate. So in this simple example, I took the time period from the end of 25 back to 2020. So you take the average of 2020, 2021, 2022, 2023, 2024, you get 76.4, okay? Now the fund value as of 2025 was 85.1. So the average is below the fund value, and that's normally the case because the market value of the fund is generally going up. So what that means is that when you apply 5% to that trailing average, you don't end up with a 5% draw. You end up, in this case, with a 4.5% draw relative to that 85 billion. So I think that's important to know. And why that's important, the longer the look back, the lower the effective draw, right? If we went back another 5 years and took the average. So that's one of the variables that's in your control. The nice thing about this formula, I think there's 2 nice things. One, the average moves around a lot less than the market value does. So the draw is much more stable. Again, if you did a 10-year, it'd be even more stable. The second thing is that operationally, we know what the draw is going to be at the end of 2024 for 2026. So that's a nice feature. I remember back when the dividend, they used to have this big meeting where they'd announce the dividend, and they were literally calculating it up at the last minute before the meeting because they based it on the end of the year, right? So they were smart enough now to look back a whole year. So this is a good formula. I have no problem with this formula. The most important input is that 5%. Is it 5? Is it 4.5? Is it 6? And so that's what we're going to look at. Any questions on?
Senator Hoffman.
Can you go over the time when the state first started the draw? That was through a Senate bill that this Finance Committee passed, Senate Bill 26.
In 2018?
Yeah.
Yeah, I think this next slide might be really good for that.
Prior to that, the legislature never touched the permanent fund except for dividends.
The dividend.
Yeah.
All right, so you set me up perfectly, Senator. This shows the history of the draw as a percentage of the fund's ending market value. So it seems to move around a lot. Much of the moving around is because it's a percentage of the ending market value, which moved around a lot. But up until 2018, you used to have the formula for the dividend, right? It was, half of 5% of the previous 5 years statutory net income. It was a lower draw. It averaged 2.3% over the period from 2000 to 2018. That was a beautiful period for appreciation of the fund. That's why you can pay $3.8 billion out of this fund right now. If you had been taking out 4.4%, which is what it's been since 2018, and I'll show you this later, the amount you'd be able to pull out now would be a lot less. Okay, so if you take anything away from this, the less you take out, the more you'll have for the future. There'll be a lot of that. So anyway, I just wanted to level set how big of a change it represented moving from the history up till 2018. You basically doubled the amount that's coming out.
Is everybody tracking that? Like, Does it make sense? Yeah, Hoffman's been there a long time. The line that I'm showing here, the 2.3%, is they're referencing up until the point where the dividend was the only thing being paid out. For many years, the dividend is what was the expense, and all of the rest of the money got dumped back in, inflation proofing the permanent fund, right? So it wasn't spent. Only until we have a 5% of market value draw are we actually spending more than what, because now you're spending it on government and some portion of a PFD. So there's more being spent out of the fund. Another way to look at it is the fund would be much larger today if we had have just been paying PFDs and not spending on government, because all of the money that got spent would have been growing in the corpus. I say all of the money that got spent in and above the dividend on government, meaning the difference between 4.4 and whatever the dividend amount is. Like, for example, if we paid a statutory dividend this year, it's a 3% POMV, percent of market value. Okay. So your fund would continue to grow larger, faster, if you only paid a dividend and didn't pay for government. So now government is taking the dividend portion and it's still going to spend it. It's just not spending it through you. It's spending it through government.
On average.
Okay, when you go to the next slide. You done? Okay, before you go there,
Sorry.
back before we did the 5% draw, we did half of the calculated statutory net income, which was distorted by, in the last few years, some big real estate sales.
Yeah.
Take that and set that issue aside. But the state reinvested their 50%. We never took it out. And that allowed the permanent fund to grow substantially higher than it would have been if we would have taken our half out and paid the other half in dividends.
Yeah.
So here's Senate Finance. I mean, I find this very ironic. Mr. Finance is acknowledging that in the past, government did what it did with its half. It put it back into the permanent fund and it didn't spend it. And then the other portion that's not the government's half got paid out in dividends. That's what he just said. Okay. So fast forward to 2025, and this started back in 2018 or whenever it was that we started spending the dividend on state government. You're taking government's half and spending it on government, and you're taking not government's half. And some of that you're spending it on government. Otherwise, you shouldn't be calling it there's government's half and there's somebody else's half. Because why would you say that? Unless that's the way that it has been. Like, in my mind, this is an acknowledgement that government has always had its half, and the dividend was supposed to be the other half, and now we're just not going to do that. We're not going to address spending or taxation. We're just going to take the dividend. We're going to take your half, people, because government over here is more important. Our half isn't enough anymore. We need more. Government needs more, and we're not going to cut government. We're not going to reduce government, and we're not going to increase taxes because the wealthy people don't want to have taxes. All the people sit at the table. Wealthy people, they don't want to have taxes, so they'll just take the dividend. You're going to get bigger government because government's continuing to grow. It's continuing to spend more. It wasn't spending the dividend. Now it's going to spend the dividend. It was putting its 50% back into the fund. Now it's not going to do that as much. Inflation proofing might be something that it continues to do, but the remainder of it, the percent of market value draw, you're going to spend it on state government. So we're going to spend our half now, and we're going to spend your half on government.
So there's that little adjustment. I know it gets lost, and when you talk to the public, they look at you like you're from Mars when you tell them that. But that went on for decades.
Yeah.
That helped build that.
Yeah. I mean, you probably already know this, but the permanent fund in the United States is like a miracle. This did not happen in any other state. Nothing close to this. The amount of savings that you have per citizen here is just, it's fantastic. So,
Right, and we're going to make it bigger, so you can continue your present.
Okay, this is really key. So the benefit of savings per person, if you don't have a dividend, the only way you benefit of that savings for the state, the collective, the communist government, the socialist government, the only way you're going to benefit is how the permanent fund corporation invests its money. Those decision makers get to decide how much money is available. The legislature, through a few people on finance, get to decide how that money is spent, and that's how you benefit. That's it. That's it. It's the people's money. It's a miracle. We're going to save it, and then we're going to bestow government on you, government services on you, and that's how you're going to benefit. It's your money. We're going to bestow it on you. This policy that exists in statute that the legislature established, and that there are still a good number of people in the legislature who want to see it happen, of the people getting to benefit directly, individually, from their money, is being ignored because people don't want to deal with the cost of government or answer the question, who should be paying for government? We want to avoid those conversations, and we just continue to take the money that's easiest to take from.
And show us how to do that.
all right.
Talk.
So what I did here, this is stay with me on this, okay, because there's a lot going on here. I went back and did what I call a historical simulation. I said, let's go back in time to 2000, because I have data going back that far on all the things I needed. And I'm going to take the actual return for each year of the permanent fund. I'm going to take the statutory return, so I knew what that was, how much statutory net income got generated. I'm going to overlay the two-account system. All right, so I've got the ERA. That's my limiter. I can't spend more than the ERA. But I'm going to overlay a 5% draw rule. Same rule, first 5 of the last 6 years market values. And I'm going to look at what would have happened. Okay.
You want to mention inflation proofing?
And I do want to mention inflation proofing. Inflation proofing has been a little bit of a lumpy process in actual history. And that's at the discretion of you all. And so you can use that tactically. Don't do it when it's dangerous to do it. But what I did is just said, if there was money left after the draw was paid and inflation was 2%, you'd pay as much at 2% as you could, right? So I just assumed that you followed the statutory formula for inflation proofing here. In fairness, that didn't always happen in the past, but I didn't want to overlay that kind of lumpy inflation proofing.
There's another thing that needs to be said right now. They're talking about inflation proofing, and they continue to talk about inflation proofing like the only way to inflation proof is if you take money and put it into the corpus through a budget decision. Okay, transfer money out of the earnings reserve account or general fund, wherever, transfer money, call it inflation proofing, and put it in the principal of the fund. Okay, what happens if you are earning your earnings that you are earning, and the equation versus and subtracting with a draw? What happens if you're earning 5% or greater, but 5% plus inflation, and then you only draw 5%? You've earned 5% and you've earned 2.5%. So that's 5% plus inflation, CPI plus 5%. 5% plus inflation's 2.5%. You've earned 7.5%. Okay? But you only spent 5%. So you've earned inflation. You've covered the inflation. You've already inflation proofed. The fund is already inflation proofing if you are earning CPI plus 5%. So adding on another payment out of the earnings reserve account or any account and adding it to the corpus to say, oh, well, inflation was 2.5% this year, so we need to put 2.5% in. No, you earned 2.5%. And you earned 5%, but you drew out 5% and you left the 2% in. So You've already inflation proofed it, but you spent 5%. So you're gonna not grow as fast because you took that 5% out. But the amount that you already left in was the amount that you necessary to counter inflation that year. So this notion that we have to add in money to cover inflation is only necessary if your returns didn't get CPI plus 5. Remember he said greater than 50% of the time, you're probably not going to get CPI plus 5. Okay, well, in those years, if you continue to draw 5% and you didn't earn CPI plus 5, then you're right. You would have to add money in. You take 5% out and you add 1% back because you need to inflation proof. You didn't earn enough to inflation proof. But when you are earning 7.5% and you only draw 5, then you're already inflation proofed. So this notion that whatever inflation is, that's what you've got to put into the fund to inflation proof is not accurate if you're earning CPI plus 5.
Here, I could have done it either way, and that's why this is a model. I'm not saying everybody would have done it this way because it had consequences. All right, so the orange bars are just what the formula would have said. So if it was a one account system, that's what you would have paid out, is the orange bars. The blue bars are what you were allowed to pay out based on the ERA limitation. So in every year where the blue bar was lower than the orange bar, you didn't have enough in the ERA to pay the full draw. So not surprisingly, right after 2008, 2009, you wouldn't have been able to pay a draw at all under the 5% rule. You'd have gone from whatever that is, $1.5 billion in 2008, down to 0 in 2009. That would have been a tough year. I don't know what the price of oil was doing.
And Alaskans have always known that if your investments weren't good and you didn't get a dividend because the investments weren't good that year, well, then maybe they would do good the next year and you would get a dividend. But in this situation, they're looking at it from the perspective that now we have to fund government from our investment earnings, and therefore we can't have a situation where from year to year, there's an opportunity for no money to come in, no money to be spent. This is another reason why they want to roll the ERA into the corpus and just take 5% of the corpus, 5% of the fund. It's to protect government spending. It's not protecting the fund. It's protecting government spending, because as it sits right now, if you wiped out your ERA through either by spending or by bad returns one year, and you don't have any money in the ERA account, we don't have any money to pay the 5% market value draw because we are not allowed to spend it from the corpus. But this is the thing, is they want to roll the ERA into the corpus, and if those conditions ever existed, where in lieu of money in the corpus, or in lieu of money in the earnings reserve account because it no longer exists, we just take it out of the corpus. The conditions might be the same. We had bad investment year and we didn't earn we didn't earn CPI plus 5, right? Maybe it's a couple of years that we've had bad returns. Oh, we don't want to face a situation where our bad returns caused our ERA to go away. So let's just roll the ERA into the corpus and then we'll take the money out of the corpus to pay the 5%. That's what they're saying. We need to protect the government spend because our government relies upon it. Like all of our services and our roads and our education and everything relies upon the permanent fund earnings. So we need to protect the spend, protect that revenue. And the only way they can protect it is by using the corpus to protect it. Which by definition, if you're wrong 50% of the time on your investments and you don't make CPI plus 5, you're going to draw down the principal of the fund to pay your 5% draw.
But this shows you that the current system, the current 2-account system, if you follow all the rules with inflation proofing, you're going to run into periods inevitably where you can't sustain a 5%.
Okay, here is the lie. Okay, if you follow the rules with inflation proofing, okay? You've got CPI plus 5 as your targeted goal. So 5% investment earnings plus in whatever inflation is, CPI. It could be 2.5 this year, it could be 3, it could be 7%, right? So your goal is to earn that much that year or that period, okay? You've already inflation proofed if you've met that. There's no need for an additional dollar figure going in for inflation proofing. And this is where the lie is said that some portion of this has actually got to get put back in the corpus for inflation proofing. It doesn't if you're managing the fund appropriately, if your asset allocations are appropriate and you're earning 5% plus inflation or whatever your target is. Lower your target to 4%, 4.5% plus inflation, and then it's easier to beat inflation. But this notion that they're pitting inflation and making this inflation payment is something that must happen. It doesn't have to happen if you're earning enough, your investment earnings are earning enough to counter inflation. It's not necessary.
It would have happened in 04, 09, 10, 12, 13, 14, and 24. None of them were as bad as 09, but 09, 10, 2010, you'd only been able to pay about half. An important thing about 2009, 2008 was so bad that it basically wiped out the ERA. Not only that, but over the next year, just normal day-to-day activity of the permanent fund, they're selling stuff, they're buying stuff, they're realizing losses. And when you realize losses, it's a negative in the statutory net income.
Okay, so I want to point something else out here. What this means, what this empty space here in 2009, what they're saying is this little teeny tiny amount of blue that showed up right here is what's remaining in the earnings reserve account. And so this payment that is represented by orange, you don't have enough money to pay. There's not enough money to pay that orange amount, right? And so you would just have $0 or 1% of what you should be drawing because there's just no money to draw it from. Okay. Which let me tell you what that means for the budget. If it was this year, and that was the situation this year, we're drawing, I don't know what is it, $3.4 billion, $3.9 billion, whatever it is. 3-point-something billion dollars is being pulled from the earnings reserve account into the general fund in order to pay for state government and dividends. Okay. So what they're saying is if this fiscal year was like 2009, there wouldn't be that $3 billion draw. You wouldn't have access to it. There would be no money there to draw it. Okay. So I want to ask the question, can anybody tell me when any of the states in our union have come to a situation where the budget that they need to spend on for the next fiscal year doesn't have any money. They don't have any money coming in. Like the state doesn't, it only has that much blue, right? This is, what is it, 1%? So whatever revenue they thought they were going to have, they're only going to get 1% of it. Is there a state that just didn't have the tax dollars come in? They only had 1% of the tax dollars come in from their private economy? Is there any state that ever had that happen? I don't know the answer. I'm going to go out on a limb and say no. You might have a reduction in the amount of taxes that come in if you've got a downturn in the economy. But you've never had a situation where you don't have any money coming in. That's what they're pointing out in 2009. That's why they're saying you have to roll the ERA into the corpus. That's why you have to give the legislature access to the corpus to spend your 5% market value draw, because you never want to be in a situation where that $3 billion, or when the fund is $100 billion, the $5 billion that comes from that, 5% of $100 billion is $5 billion. You don't want to be in a situation where there isn't $5 billion in the ERA and you don't get it that year. So you're going to authorize yourself to take it from the corpus, regardless of whether your earnings allowed you to or not. Meaning you earned enough to take it that year. We are not a healthy state We're not a healthy state because we rely on permanent fund earnings. We're a healthy state because we rely upon a robust private economy. And the taxes that come from a robust private economy support the size of government that that economy can support. If we go down this path where we authorize the legislature to spend from the corpus in order to protect the 5% draw, inevitably, you will see a decline in the amount of your permanent fund over time. Because greater than 50% of the time, they're saying you're not going to earn CPI plus 5. Every time that happens, it reduces the amount of money that you have in the fund to invest the following year. And that means over time, that money that's not there anymore to invest doesn't earn you interest, and it doesn't grow the fund. All right. Look, folks, we're at 2%. We're at 2 hours. This is 3/4 of the way through the meeting. I'm going to call it a day. If I get enough feedback, we can have another meeting and have another show and cover the rest of this. But I think you get the gist here. This is the play for the legislature. This is the play for finance. Because there's not a big enough vision that says, hey, we need to do something to increase the private sector. We need to do something to grow our economy. I don't know. Let's figure out how to lower the cost of electricity. This team that's sitting at the table is not thinking about that. They are spending time, machinations, strategies, trying to figure out how they can get enough votes to get themselves access to the corpus of the fund to ensure, to be certain that every year, regardless of how the investment team in the Permanent Fund Corporation does it, they've got their money for state government. That's what they're worried about. You thought we had an oil curse, a resource curse. Now we're going to have an investment curse. Nobody is going to care about the private economy because they've got the permanent fund. Every year, you're going to get your 5%, whether we did a good job investing or not. Yes, the presentation is downloadable. Let me get you that link real quick. I should have access to it here. I'm going to stop sharing the screen. I think I've still got it up here on the other window. I do. Here is the link. Copy all that. I'm popping it up in the chat here. Let me make sure Senate Finance. Yep, this is it. Okay, so this is the link to KTOO. It's in the chat now. That's the link to the entire presentation, and we're 3/4 of the way through it. Well, maybe 2/3. Anyway, I would encourage you. There's some good questions for the remainder of the meeting. I would encourage you to go watch and listen to the rest of it. But I think we got the gist of what you get the flavor of what's going on here. Okay. Oh, just the PowerPoint. Yeah, sorry, that was this. Okay, I'm going to show you. I'm going to teach a man to fish. I'm not just going to give him a fish. You're going to hate me for that, right? You're like, just give me what I want. I don't want to, no, give me the baby, not the birth pains. No, that's not what I need. I'm so obstinate. Okay, I'll show this and then I'll go akleg.gov. Bam. Committees. Standing committees. You with me still? Senate Finance. Meetings. 25th. Oop, that's March. 25th. 9 a.m. Documents. PowerPoint. Right here. Copy link. Look at this. I'm going to do you a favor, and it is, bam, placed in the chat. So there's the link. So I gave you a fish, and I taught you to fish. Hope it works. All right. Hey, appreciate you joining me tonight. I might have been the only one here that enjoyed watching this again, because this is the second time I've seen it now. But I have thoroughly had fun sharing my thoughts and my perspective here. You know, when I first got to the legislature in 2019 for the fiscal year 20 budget, I went right on to finance. And I was drinking through a fire hose because I'd never been on finance. I've never done anything like that before. Turns out I liked it. 4 years I spent on finance, and then the last 2 years I was chair of House Ways and Means and Legislative Budget and Audit. But the 4 years on finance helped me to understand and asking questions and really just learning, teaching, learning, asking questions and learning. And so a lot of this makes sense to me now because I've seen it enough times and I understand what, you know, sometimes is being said and what isn't being said. So I have enjoyed being able to communicate. Hopefully everything that I have added to this, you know, I've never worked for the Permanent Fund Corporation and I'm not an expert in finance. I'm just a layman here trying to communicate in layman's terms what my understanding is. So hopefully what I've said is accurate and I don't misunderstand stuff, but so somebody you want to fact check me or correct me, I'll stand corrected if I'm wrong, but I don't think I am. I don't think I am, especially the end result here that they're after. Protect the spend. Protect the spend. It's not protect the fund. Now, if you were to put a constitutional amendment in place, and I'll just plug this here. If you were to put a constitutional amendment in place that said the legislature cannot draw more from a single permanent fund, you roll the ERA in, they cannot draw any more than your earnings plus inflation. Meaning you're never going to dip into the principal in order to pay something out. You wouldn't be guaranteed a 5% draw because if you didn't earn enough to cover inflation, then you don't get to draw it out. But that's not what they're trying to do. They're not trying to protect the fund. They're trying to protect the spend. So it is very unlikely that they would put that in the Constitution that would say from year to year, you wouldn't be able to predict how much comes out of the fund. You wouldn't necessarily be able to draw 5% every year because you didn't earn enough. That would protect the fund. That is not what they're proposing. They're proposing to just be allowed to draw 5% regardless of what your investment and inflation strategy obtained that year. More money. That's exactly right. More money. Other people's money. OPP. Other people's money. OPM. Sorry. Okay. Thanks for joining me tonight. So I want to share something with you really quickly. Let's see if I can get this up real quick. All right. Back to the website. It's probably org. Nope. The. Okay, folks, this is where I'm going to be tomorrow night. I just wanted to be clear that I'm not going to have a live show tomorrow. The Compass is a nonprofit that exists here in Nikiski. It is encouraging, equipping, empowering youth of Alaska. So it's like a youth drop-in after school and a coffee house. It's become a staple for our community here in Nikiski. And it's something that I have supported since the foundation. I was on the initial board of directors that stood this organization up. I'm no longer on the board, but I've supported this organization. So this is where I'm going to be tomorrow night, is attending this fundraiser with my wife. And if you're interested and want to donate to this organization, there's a little link up here to click and donate. And any help that you can goes to a good Christian cause where they're reaching out to youth after school and at other times. It's a really good, worthy organization that's fully supported by the community. Zero state dollars, zero government dollars are going into this. It is all from this local community that's pulled this thing together. And anyway, so that's where I'm going to be tomorrow night. If I can squeeze it, I'm gonna record something tomorrow and broadcast it or have it available for tomorrow night. But I will not be doing a live show tomorrow because I can't be in two places at once tomorrow night. So just so you're aware, don't expect me to be live tomorrow. But it'd be for good cause. So. Craig is asking a question. Was there open discussion between legislators on the strategy to combine the funds? I'm not sure what the context is. While I was in the legislature, or with regard to the current bills that are before the legislature? What is it you're looking for, Craig? If it was while I was in the legislature, yeah, I mean, of course, we had conversations behind, in committee and outside of committee. Not so much in committee, but outside of committee, there was always conversations going on with regard to, the wisdom of doing something like that. And I would assume that the legislature is dealing with that now. The way that this is going to happen is through a resolution. So any constitutional amendment has to be is presented to the legislature as a resolution. The governor doesn't have to sign it; it goes to the people for a vote to amend the Constitution. So I don't remember the number of the resolution, the number of the bill in the legislature right now. I could go search for it, but we're out of time. You could go search for it. Go to the akleg.gov and type in earnings reserve account or something like that, and it's a constitutional amendment, and it'll pull up all the constitutional amendments, and you should be able to find it there. But the important conversations are what's happening on the record, I guess. I mean, for you, that's what you're going to get to see. Off the record conversations, you don't get to see. Okay, folks. Thanks. I will enjoy our date. We'll see you Monday night. Have a good weekend. Have a good Friday and have a good weekend. Thanks for joining Oversight Live.